to the test right now with Doug Flynn, who joins us from here in New York. Doug, good to see you, my friend. Haven't seen you in a while. How's everything?
Good morning, Connell. How are you?
I'm all right. We started. It's always weird, as you know, in markets. We start to say, are things maybe too good? As you look at the jobs report expectations, 180,000, 4.1% unemployment rate, and this Atlanta Fed indicator came out. They have this GDP Now model, and it says, well, you know what? We might have 5.4% first quarter growth. I'm like, whoa, sounds ridiculous. Obviously, if it happened, big if, that would be great for the economy. But might it be too good? And that we're starting to worry about the Fed here, starting to worry about inflation. What's your take?
Absolutely. I think, there's a typical seasonality that goes on in this GDP, so having a little bit higher one is not abnormal. But what that does is it puts people on notice that perhaps the 3 Fed raises that they're anticipating, maybe they need to do a 4th, and that's a little bit spooky for people because we have to readjust to the markets moving more than 1%. It used to be 1 to 2% moves on a daily basis were fairly common.
Right.
We've completely not had that for about 9-10 months with any regularity.
Yeah,
so people
it surprises us, right, to see. I mean, and it again, I said this earlier, but it looks like a bigger number than it is sometimes now because we've had this ridiculous run in the markets. To see down 270, you say,
True.
Whoa, wow. But that's 1% of where we are right now. So what type of a pullback to your thinking would be healthy right now? And, do you worry we might start to slide a little bit more as people start to see these numbers? I mean, again, 2.8 on the 10-year.
Sure.
Is that something that worries you at all?
No, we've anticipated that the market could handle up to 3.5% interest rates without it becoming overvalued. There's a couple things to note. If you look back, like the January indicator is one that we look at because it's fun to look at. When the market is up in January, the typical remaining 11 months are up on average of about 12%. So that's a plus. Since the S&P has been around, when January has been positive, the market has not been negative for the entire year ever. That's 12 for 12. So that doesn't mean that we can't have what we're anticipating would be an 8 to 11% correction along the way. Now, that just represents a buying opportunity because we're not terribly overvalued. So I would welcome some volatility. There's a lot of dry powder, a lot of cash on the sides that you could look to get in during that kind of environment.
Is that what you buy each and every dip? I mean, that's what people have done so far, right? You get a little bit of a dip, next thing you know, say hypothetically we're down today, could be a few hundred points. We don't know how the jobs report will come out. But then, if the pattern holds true Monday, we could be up a few hundred points. Right?
Exactly. I think that's an opportunity to throw a little bit of money. A lot of people have been sitting on the sidelines waiting to get in. A lot of this has passed many people by. So these are those opportunities to just throw a little bit in and work your way in during the volatility that you hope comes back, because that just keeps once everyone's back in and everyone thinks it's a party and it's 1999 all over again, that's when I get worried, and we're nowhere near that.
Well, are we? Yeah, because there are some signals. If you look at sentiment indicators, for example, that are they're flashing a little too much bullishness for some people's taste. We're looking at these tech stocks as an example. They've run up so much that people start to say, oh boy, this looks like at least a yellow, if not a red light. But you're saying we're not there yet? We're not too optimistic?
Well, look, on an overall basis, the market is a little bit above normal valuation, but it's not more than what we look at, one standard deviation. That's where you start to get a little concerned. Now, that being said, in the 11 sectors of the S&P, technology has been the best performer and has been for a while. That continues until it doesn't continue any longer. And so you have to just look at some of the other sectors that haven't participated. That's what I'd be looking at. Stop chasing everything that's always been the highest performer. Look for some of the other areas. All
right. Good to talk to you again, Doug, and hopefully see you sooner than I haven't seen you in a few years, I don't think, but good to see you.
See you around, Connell.
All right, Doug.
Okay.
All right.